You know, I always say to an audience, only clap at the end, because I might suck. You never know. So, what I'm talking about today, it looks like it's coming up over there, is something that's very close to my heart. I've been a founder of companies pretty much my whole life. I actually never had a real job, except when I was in college. And as a founder of a company, and now I've done lots. TechCrunch is a great example because TechCrunch lasted for 5 years. It takes a lot out of your life, and for those 5 years, you really don't earn anything. You can barely even pay yourself. So the venture ecosystem is kind of challenged by a problem called liquidity. This graph kind of gets into the details of why. It's coming from Crunchbase. And on the left-hand side, it shows the last 10 years of venture investing amounted to about $600 billion. It's worth noting that that $600 billion produced 1.8 trillion of returns for the investors, but only 10% of the 600 billion was responsible for those returns. 90% is still illiquid. Some of it, of course, is dead, but much of it is locked in companies that are great or good, but not liquid. Very large amount of that. If you look at the next 10 years on the right-hand side, that taking 2017 as a base year, it's going to be about 1.5 trillion of illiquid investments. Now, the word illiquid investments, it's a kind of sounds like an economic phrase, but if you translate it into human, it's people like you doing a startup, getting shares in your own company and not being able to sell them, any of them. So you might get paid a salary and your company might be doing really, really well, but you can't cash in what you've achieved. It's locked up in the assets of your company, and most of your net worth will be locked up along with it. If you're an angel investor and you maybe have 5 or 10 or maybe even 20 investments, most of them will be like that, where you've put the money in, but you can't yet get anything out. And these days, that can last for more than a decade before you get acquired or IPO, or perhaps neither, in which case it lasts forever. You're just illiquid. One of the great things about blockchain is that you can make things that are illiquid liquid by tokenizing them. So Venture Network is seeking to tokenize the assets of the venture ecosystem. To do that, we had to solve 3 problems. 1, liquidity. 2, diversification. That's, I'm a founder of my company. My whole net worth is in my company. Wouldn't it be great if I owned a piece of some other companies as well so that I was diversified? And the third thing is the venture ecosystem it's really a rich person's club, mainly a rich man's club, where access to the best deals is completely controlled by a very small number of very large organizations, like CalPERS, the California Pension Fund, or the Stanford Endowment, and places like that, who are the main investors in venture funds, like Sequoia or Accel or Benchmark. So what if we could solve all these 3 problems? And we come up with a reason why you have to do that. This is a graph of how many startups die before anybody gets liquid. At the top is all the startups that get funded in a cohort, and at the bottom is the ones that survive by the time you get to the end. So the largest ecosystem of innovation on the planet is massively risky and highly illiquid. So this is what we came up with. There was no single easy way to solve this illiquidity, so we had to end up doing 3 things to solve it. The first thing we did is we created a company in Switzerland called Venture Network that is going to give rewards to every founder and every investor in startups. Think of it as United Airlines giving miles every time you fly. What we're going to do is we're going to give venture tokens every time a company gets funded. And we've formed a partnership with Crunchbase, who will report to us every funding event in the world. And by the way, that's whether it's an equity sale or an ICO or a token sale of some kind. They'll report to us every single funding event. And the Swiss company will offer the founder of the company that gets funded and the investor one venture token for every dollar invested. So if you raise $1 million, the investor will be offered 1 million venture tokens as a reward, a pure gift. They don't have to give up any of their equity. And the founder will be offered 1 million venture tokens as a reward. Again, they don't have to give up any equity. It's a pure reward, just like airline miles, for having accomplished a goal, not flying in this case, but getting your company funded. That's step one. If you go back to the illiquidity, where I said 1.5 billion of illiquidity over the next 10 years, and let's assume 100% of every funding event accepts the reward tokens. It's 2 tokens per dollar raised, one for the founder, one for the investor. That would suggest that we will give rewards of about 3 trillion tokens over 10 years. At that point, they're worthless. It's like a point system. We're just giving out rewards. So how do we make them liquid and worth something? So the second step is that we're going to do a token sale. It actually started on June 1st. It's in a private sale SAFT phase, so only open to accredited investors in the US. And we're going to take 10% of 10 years rewards and sell them for 1 cent each. 1 cent each, that's 300 billion tokens, if you do the math on 3 trillion. At 1 cent each is $3 billion. Now that's a big number, and no one's ever done a $3 billion token sale apart from EOS. So it's very unlikely that we're going to sell $3 billion worth of tokens. So it's worth telling you that isn't the goal. That's just the maximum we could raise if the whole thing sold out. What the goal actually is to do the token sale, to sell some percentage of $3 billion, to take both the sold and the unsold and endow them into a second entity, a crypto fund. This will be called the Venture Network Fund, and it's based in Bermuda because that's a good place to put funds for legal reasons. And it will have some fiat currency, some Bitcoin, some Ethereum, and lots of venture tokens. Paper value of that fund will be about $3 billion on day one if you add all of those together. And it's going to start investing in token sales and in equities, 90% token sale, 10% equities, and it will be perpetual. Both the rewards and the fund are perpetual. This is a very special fund. It's not really like a venture fund where you have to give money back to your investors every time you invest it and succeed. It's what's called an evergreen fund because there are no investors, more like a family office, if you will. And every time it invests, it will make gains, and those gains will be plowed back in to further investment in the second year and the third year and so on. So it will compound. So we've got a rewards program and we've got a fund. We still haven't figured out how the tokens are worth anything. So for that, you need the third step. Like all funds, the Venture Network Fund is not owned by its managers, us. It is 80% owned by somebody else. In a normal venture fund, that's the limited partners, the Stanford Endowment and so on. In our case, it's the venture token holders. Anyone who holds venture tokens will own 80% of all the assets the fund invests in. And so what the fund is going to do is put every time it completes an investment, the day the investment closes, it's going to take 80% of the asset and put it into the venture network marketplace. And this marketplace is open only to venture token holders. And any venture token holder, whether you bought it in the token sale or whether you were rewarded it for having your company funded, can go to the marketplace and trade their venture tokens in for actual assets that the fund invested in. That way, we will return 80% of everything the fund does back to the community who holds venture tokens. And the community will be made up of 3 groups of people. Firstly, the token sale buyers. Secondly, founders who got their company funded. And thirdly, investors who funded the startups. So we'll be returning liquidity back to the ecosystem. On day one, a venture token will be worth 1 cent. And so when we give you a venture token as a reward for $1, we're basically giving you 1% liquidity on your funding round. 32% if you add together the investor and the founder's tokens. Our model suggests that over 10 years of investing, the asset base of venture token will grow from 0.6 of a cent on day one to 32 cents at the end of 10 years. And that's assuming 100% take-up of the rewards. In reality, the take-up is going to be much less than 100%, but it's the worst case from a value point of view, so let's use 100%. 32 cents value per venture token as an asset base means that now, if you raise $1 million and I give you one venture token per dollar, 10 years from now, you'll be getting 32% liquidity, not 1%. And if you add the two together, it's 64% liquidity. So by this method, over a period of time, we end up making investments liquid for both founders and investors. We're actually going to cap out the liquidity at 25%. So that 32% number I just mentioned will never actually happen. It's capped at 25% each for the founder and the investor, making a total of 50% liquidity. And that will be pumped back and become fungible in the hands of founders and investors. So basically, that is Venture Network. Venture Network is not a venture fund. It is not a crypto fund. It is a method of returning liquidity to the entire venture ecosystem. If we do that, founders and investors obviously benefit by being diversified and liquid. The community benefits because this is a big fund. We will have access to the best deals, so venture token holders will have access to the best deals. So we solve the three problems that we started with. This is a detailed slide that shows you the flow, and this is available online at venturenetwork.io, so you can go and, it's called /lightpaper. So if you go to venturenetwork.io/lightpaper, you'll see these slides. This is the flow that shows that what I've just described happens, and it's all enshrined in 3 smart contracts. Smart contract 1 issues rewards. Smart contract 2 endows the fund from the token sale. Smart contract 3 forces the fund to invest 80% of the assets it buys into the marketplace for trading with venture token holders. Venture token holders really have 3 choices then. They can hold their venture tokens, assuming they'll go up in value. They can go on an exchange and sell them for Bitcoin or Ethereum or whatever they want, or they can trade them in the marketplace for the assets the fund invests in. The final piece is the marketplace will also be open on the sell side to third parties. So let's say you're an angel investor or you invested in an ICO that isn't liquid, you would be able to come and list your assets in the marketplace in exchange for venture tokens as well, which means that the marketplace will have even more assets under management than the fund puts in there, meaning the asset base of the venture token will be much bigger than just the fund. From the point of view of all 3 players then, founders, investors, and the crypto buyers, this is a big plus. And how do you get venture tokens? It's very simple. You found a company. You get the company funded. You report the funding event initially to Crunchbase, although we expect there'll be other authorities over time. Crunchbase notifies our smart contract of the funding event. We offer the founders and the investors the venture token. If they accept them, then the tokens are minted. If they don't accept them, the tokens are never minted, so they don't dilute the token base. They then are put into their hands, and from that moment onwards, they can go to the marketplace and trade them for other assets, or they can hold them. By now you realize that venture token is a security token and it's asset backed. So the sale is a security token offering, not a utility token offering. That's why it's Swiss domiciled, and is conducting its token sale in the US at least using a Reg D filing and proper US compliance. That's why you have to be an accredited investor to buy the tokens. There is a roadmap, which I won't go into here. It's probably too long and boring, but obviously there's a lot of software involved here. Venture Network is essentially an autonomous organization, a DAO, with 3 smart contracts operating the whole thing without human intervention being required to enforce the rules. If you look forward 20 years, about less than 5% of the tokens will have been given to the team, and less than 5% of the tokens will have been sold in the token sale and used to endow the fund. That's a very small percent going into the fund. And the reason for that is the fund structure as an evergreen fund. If we invest $150 million in 2019 and we make a profit, let's say, of $300 million, we don't have to give that $300 million back to any investors. So in 2020, we now have $450 million to invest. And if we make a profit on that at the end of 2020, in 2021, we have $450 million plus whatever profit was made, plus another $150 million from that year. Numbers are a bit hard to follow if I just speak them, but trust me, it compounds year over year, and we don't have to give value back to any investors in the way the fund is structured. So actually, the tokens that dominate our universe are the reward tokens, and the liquidity we give to founders and investors becomes the primary use case of the tokens. As I said, we're going to invest 90% into token sales and 10% into equities. However, if the market shifts, that could become 100% token sales, or it could become 50-50. Where are we? We started a private sale to accredited investors 2 weeks ago. I should say that the minimum check size there is $500,000, so it won't surprise you that most of the investors are people who can write larger checks, mainly organizations who are involved in blockchain infrastructure, either exchanges or actually blockchain owners or funds. At the end of this month, we go to the longest phase of the sale, which is also private, where we will sell here in the US to accredited investors, and there the minimum check size drops to $50,000, but it's still a big check. And at the end of August, we move to a public sale, and sadly here in the US, that will not be available because of the Reg D rules, but it will be everywhere else, almost everywhere else. So what are the benefits? The benefits are that we found a way to organize the entire founder and investor ecosystem to act together through a reward system to bring liquidity to the entire global funding ecosystem, the entire venture ecosystem. We think that the asset value we can produce from the fund will suggest something like 100x return if our model for the fund is correct. And of course, disclaimer, you can't trust anything I said there unless you go and look at it for yourself, but that is what the model suggests based on fairly normal performance of a fund. The only way to get the assets of the fund will be to own venture tokens. So you can either buy them in the token sale, or you can be rewarded with them, or you can buy them later from people who have them. We anticipate the fund, because it will be writing big checks, will qualify for very large discounts in its token purchases. And when we get those discounts, the listing price of what we buy in the marketplace will be our purchase price. In other words, we will not look to mark up the assets we buy through the fund. We're acting as the custodian of the fund on behalf of the community, and so it would be inappropriate for us to make a profit. So we're going to list at the purchase price, but it will not be a first-come, first-served sale. It will be a Dutch auction, which means that we eventually will establish the right price at which 100% of the asset sells to venture token holders. Those venture tokens that are used to purchase the assets come back to the fund, and then we reinvest those on behalf of the community in the following investing cycle. So it's a self-fulfilling kind of cyclical model. We do believe because of this, we'll get access to the best deals, which would normally be unavailable to people. And we think that, or we hope, that by doing this, we're actually revolutionizing what venture investing and startup founding represent from a risk point of view. We're making it way more exciting to take on long-term, innovative projects that everyone in the world can benefit from. And with 8 seconds left, that is me. Thank you for listening. We've got a great team, by the way. You can see that on the website. Great advisors, including Eric Lee, who co-founded LinkedIn. Venture Network. Thank you so much.